Well, hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B. We are in week 5 already, so that means we made it past the halfway mark. Yay! Hey, all right, yeah, we're almost there. Yeah, we got 4 weeks left, so that's fantastic. An 8-week course. So, before we jump into fixed assets, let's quickly talk about where we are, where we're heading. So in the classroom, we are currently in week 5. We had just finished up week 4, current assets and liabilities. Week 5 builds on the concept of assets. And this is more, I guess, what you would call more quote unquote long-term assets or long-lived assets. These are commonly known as fixed assets. Basically, we're talking about property, plant, and equipment, which you'll hear referred to as PPE, property, plant, and equipment. Okay, so as we discuss property, plant, and equipment, you got your 3 learning resources for this week. Please definitely look at these in addition to, of course, this lecture and the PowerPoint presentation. There is a discussion on property, plant, and equipment as it relates to your 10K project. That'll be a fun discussion. I mean, they're all fun, but that one's pretty entertaining. You will have a homework assignment. The homework assignment, week 5 homework assignment, will cover property, plant, and equipment topics, depreciation, amortization, those types of questions. Don't worry, we'll walk through it. Oh my goodness. And of course, in addition to your weekly report, we have exam 2. Exam 2 covers the past 2 weeks, covers weeks 3 and 4. So content from merchandising, content from assets and liabilities. There may be 1 or 2 questions related to week 5 content as well. So just as before, my recommendation for success on the exams is to go back and review the 2 previous weeks and wait to take the exam until closer to the end of the week. I would do it after you've completed your week 5 homework assignment. That will certainly set you up for success on the exam. And of course, one of the other recommendations I have for success on exam 2 is in weeks 3, 4, and 5. Toward the end of the page, you'll find the self-assessment. Self-assessment, I strongly recommend you review the self-assessment. It will certainly help. And if you feel so inclined, you're more than welcome to review your homework submissions from the previous weeks. And with that, that's my recommendations for exam 2. So this week, it's all about fixed assets, property, plant, and equipment. The previous week, we talked about current assets, liabilities, and the week before, we talked about merchandising inventory. So week 5, it really does build on the previous 2 weeks. And so without further delay, let's go ahead and jump into fixed assets. So fixed assets. The idea behind fixed assets is that the assets are long-lived, they're permanent, and they include things like machinery, equipment, buildings, and land. Property, plant, and equipment, PPE. In most cases, on your 10K reports, when you're reading through them, they're typically listed as fixed assets. You'll see them listed as property, plant, and equipment. These are physical, tangible assets that are owned by the company and are used in normal day-to-day operations. They are typically not offered as a part of, they're not offered for sale as day-to-day operations. So in other words, the business is not in business to be selling buildings, equipment, or machinery. That is not a normal part of operations. So it would not be, it would, and if that is the case, it would not be classified as fixed assets. So in other words, fixed assets are designed to help the business to generate revenue. That's what the purpose of fixed assets are. In other words, if a building or if a company is renting a building or leasing a building, or if they own the building, they're using that building to help generate revenue, then it is a fixed asset. The same could be said with equipment. If the company owns or leases the or well owns if the company owns the equipment and it's being used to generate revenue, then it's a fixed asset. If the company owns a piece of equipment or a building and its primary purpose is not to generate revenue, then it would be considered an investment, not a fixed asset. Okay, so along with fixed assets, one of the very important things is to understand how that fixed asset is classified, whether it's fixed asset investment or an expense. I've given the example of a building, whether it's owned or leased, rented, right? So the first part or the first step of classifying is determining whether it's owned or leased. If it's owned, it's a fixed asset. If it's leased, it's an investment. Or I'm sorry, well, it's technically an expense if it's leased. Because if you think about the way that we formulate our balance sheet, income statement of cash flows, is when there's a lease, we journalize it as a lease expense. So it would show up as an expense, meaning it is not an asset. Assets, as you know, are things that the company owns. So if the company owns the building, it is a fixed asset. If the company owns the machinery, it's a fixed asset. If the company owns the land, it's a fixed asset. Now, here's the part about investments. If it's not used in day-to-day operations and it's an asset, then it's considered to be an investment. An investment is still an asset, but it's not used in day-to-day operations. Oftentimes on your 10K report, you'll see an investment asset is it'll say assets held for sale, or it'll say investments held for sale, or it'll say something along those lines. But it's technically an investment because it's not used in day-to-day operations. And if we purchase the long-term asset and it's used in day-to-day operations, it's property, plant, and equipment, then it's a fixed asset. If we purchase the asset and it's not used in day-to-day operations, it's an investment. That's the best way to think about it. In all other cases, if it's a lease, then it's an expense. In other words, if we're renting the equipment or the machinery or the building, it's an expense. And then step two, as we're classifying the costs, is the asset used in normal operations? If yes, it's a fixed asset. If no, it's an investment. I mean, really, you could probably combine steps 1 and 2. It's pretty straightforward. Moreover, as we're classifying these assets and we're looking at their makeup, their structure, we typically, almost always, I would say, A fixed asset will last longer than 1 year and it'll be in normal day-to-day operations. Um, Otherwise, it's an investment that is on the books that is held for future sale if it's not day-to-day operations. So here are uh, costs that are associated with the assets. So again, when we're talking about long-term assets, we're talking about property, plant, and equipment. These are long-term or fixed assets. And along with these fixed assets, there are a lot of different costs. Now, not all of these costs will be there, right? Because not all situations are the same. If you're buying a piece of land with a building already on it, there's a good chance you're not going to accrue architectural fees or engineering fees, but you'll have other types of fees. So associated with buildings, there's insurance costs, interest on borrowed construction financing, sales taxes, repairs, reconditioning, modifying it for use, permitting, so forth and so on. The list goes on and on. The overall point that I'm trying to get at here is on your balance sheet, when you have a fixed asset that is a building, that total cost associated with that building includes all of these costs. So it says building $1.5 million. Well, of that 1.5 million, maybe only $1 million of it is the actual building itself. The rest of it comes from these various fees and costs and this related things, right? But it's still 1.5 million because all of these costs are associated with that building. Think of it as the cost of acquisition, the cost of owning that building. It's not just the building, it's the building plus all of these related expenses. But what about machinery and equipment? So let's say we purchase some new machinery and equipment for our to put in our building. Machinery and equipment is its own. Each piece of machinery and equipment is its own fixed asset. And along with that piece of machinery, you have sales tax, freight, installation, repairs, reconditioning, insurance, assembly, modifying it for use, testing it, permitting it, you name it, right? So all of those costs, you add them all up in addition to the initial cost of the machinery, and that's your total cost for that asset. And the same thing for land. Land, we have the land itself, which is the purchase price. You got sales tax, permitting, brokerage commissions, titling fees, surveying fees, real estate taxes, removing any unwanted things on the land, grading and leveling, so forth and so on. All of those costs are related to the piece of the land that is being acquired. So you add all that up plus the purchase price of the land, giving you the total cost of the land. And then, of course, we have land improvements that are related to the land, but are typically expensed out, but could be included in the acquisition of the land. And we're going to talk about how we separate those out. So there are costs that are very necessary when it comes to preparing the fixed asset for use, of course. And then there are unnecessary costs. Unnecessary costs are recorded as expenses. So I want you to think of an asset as something that is useful. It has a useful life. When you hear the term useful life, it means I can utilize this fixed asset over time to help the company to generate revenue. In this example, we'll use a piece of machinery. Okay, piece of machinery. And this piece of machinery, we'll say it's a forklift. Okay, I have a forklift, and I use my forklift in my building at my warehouse to transport inventory. Okay, very typical. That's a very normal asset. My forklift has a useful life, meaning I expect this forklift to last X number of years. Yeah, absolutely. Forklift typically lasts about 5 years. So there are what we call costs that can either increase its usefulness or not increase its usefulness. When it does not increase usefulness, we record the cost as an expense. Examples would be things like vandalism, mistakes in installation, uninsured theft, damage during unpacking and installation, fines for not obtaining the right permits, and so forth and so on. And you could also add oil changes. So I changed the oil on the forklift. Changing the oil does not increase its useful life. You're just maintaining it. Maintenance is simply an expense. Maintenance is an expense until it's increasing the useful life. For example, on the forklift, if I do repairs and maintenance and it's just, oh, I'm changing the oil, oh, I'm putting a new belt on the drive shaft, oh, I'm doing whatever else to the engine just to make sure it keeps living, regular wear and tear things. That's just repairs and maintenance expense. That is not increasing useful life. Increasing useful life would be, I did an overhaul on the engine to get the engine to last another 5 years. That increases its useful life. And that is totally different. And we'll talk about those types of things. So let's look at this as an example. Since this is accounting 220, let's look at it from the perspective of a journal entry to help us to understand the cost of the asset. Okay, so let's assume our company purchased a piece of equipment for $12,500. The cost of the freight was $600. The cost of installation was $1,500. And there was a problem with installation of $500 that cost us $500. So this is the journal entry that we would make. We would debit equipment $13,600 to increase our equipment account, which, by the way, is an asset account. And we would credit cash to decrease our cash by $13,600. We paid cash for it. So why $13,600? You might be asking. It's the purchase price plus transport plus installation, but then minus an error for installation. So the error for the installation, instead of contributing to the cost of the equipment, we end up recording that as on expense. The idea of a building is a little bit different. If the building already exists, you will not be using the construction in progress account. But if the company is building a building, the cost will be capitalized. And the way that we would do that is we would debit construction in progress, and we would credit the related costs. What that does is it helps to capitalize the related costs that are utilized in building a building, as they say. And then when the construction is complete, we would simply um, debit the building and credit construction in progress. I don't believe that is on the exam or on the homework, so you don't have to worry too much about it. It's good to know. Good to know. Well, leasing. I talked about a little bit about leasing earlier. Leasing, in most cases, can be classified as a fixed asset. A lease is a contract agreement for the use of an asset over time. The lease itself is typically classified as an asset. The reason being is because the lease identifies who actually owns the asset. There are two parties to a lease. There's a leaseor and a leasee. Leaseor is who owns the asset. Leasee is who's using the asset. So if you think about like an apartment that you're renting, the leaseor, that's your landlord. The leasee, that's you. Because the apartment is owned by the landlord, who is the leaseor. You are using that apartment. You're the leasee. A couple of advantages about leasing. Leasing this asset, you don't have to worry about separating funds. Expenses like repairs and maintenance are typically the responsibility of the leaseor. And risk is typically transferred to the leaseor, so you don't have to worry about risk. So those are some. Oh my goodness, I'm so sorry, I skipped that. So that's leasing. Leasing, again, most of it just gets expensed out. We're not going to dive too deep in this class on leasing, but that is something that will come back in 221. And then for those of you who are accounting majors, you will definitely see that again in 310. Will be the next time you'll see that. Accounting for depreciation. Okay, depreciation is a very important concept I want all of you to understand. Depreciation. The idea behind depreciation is that over time, the fixed assets lose their usefulness. Absolutely. Think of like a building. What happens to the building over time? It gets old, right? What happens when the building gets old? It starts to fall apart. Okay. Same with the machine. What happens to the machine over time? It gets old, it wears down, it falls apart. What happens with, well, everything except for land, right? Land doesn't fall apart. Land doesn't lose its value. Land is considered to be infinite. Land is infinite. Everything else, on the other hand, the building, the equipment, the machinery, all of that depreciates over time because it loses its usefulness over time. The only thing that does not depreciate or lose its usefulness is land. The physical dirt that you're currently standing on does not lose its useful life that we're aware of from an accounting perspective. So we do this thing called depreciation. In the process of depreciating, we are accounting for the loss of usefulness. So I'm going to use my forklift as an example here. My forklift. I purchased that forklift for $25,000. Wonderful forklift, very nice. Okay. I was told by the IRS, very true, by the way. IRS says the forklift useful life is 5 years. Okay. There's a report. It's called the MACRS report, and it tells you how long things are supposed to last. Bought the forklift for 25,000. Lasts for 5 years. At the end of year 1, I will reduce the value of that forklift by X number of dollars. If I use straight line depreciation, I am reducing it by $5,000 at the end of year 1 with a journal entry, adjusting journal entry. And I'll do the same thing every year until it reaches a value of 0 at the end of year 5. That is the concept of depreciation. I am accounting for the obsolescence. I am accounting for the reduction in longevity of the fixed asset. Before I jump into a deep dive into depreciation, I want to help you to understand this concept called book value. And you can apply this same exact concept to your own personal assets, like your car, your house, whatever, right? The idea of book value is we take the cost of the fixed asset minus the accumulated depreciation. Okay? That's book value. And book value does not measure a decline in market value. In other words, book value is not the same as market value. Okay. Book value, cost of the asset minus accumulated depreciation. Market value is how much the open marketplace says the asset is worth. Okay. And you know that's based off of supply and demand or the open market. Okay. So think about like when you go to buy a car. Okay. You go to buy a car and you're going to get a used car because you know better, right? You know better. You're going to get a used car, not a new one. And the reason why you know better is because of depreciation. You say, you know what, Dr. B, I'm going to get a used car because I know that the second I drive that brand new car off the lot, it's going to depreciate substantially in value. And that is very true, by the way. Usually drops by close to 40% in value. The reason why that occurs is because of, again, usefulness, depreciation. So you go to the used car lot and you find a car that you like and you say, okay, well, I wonder what I know what the market value is because it's on the sticker on the window. But you know that that's not really what that car is worth. You know book value. That's where you take the original cost minus depreciation to give you the true value of that used car. So what you'll find is book value will never be the same as market value. It just does not happen. And reasons for that, people like profit. And depreciation does not do anything to cash. Depreciation is not the same as cash. Do not think depreciation and cash are the same. They are not. They are very, very different. We do not use any cash has no impact on depreciation. Depreciation, we are reducing the value. We're not reducing cash, we're reducing value. So separate your mind when you're thinking about depreciation. It is not cash. Very, very different. Okay, so here we go. Now, as there are a couple of different ways to compute depreciation. Depreciation, as we said, is the reduction of the value of an asset over time, a fixed asset over time. There's a couple ways to compute it. There's the straight line method, which I gave in my earlier example of the forklift. Bought it for $25,000, lasts for 5 years. At the end of each year, I deduct $5,000 per year up until the end of year 5 when it has a value of 0. That is straight line depreciation. There's another method called double declining balance, which we will talk about. It's you take the straight line percentage, multiply that by 2, and I'll show you. It's a little bit more complex. There's a couple of other methods. Those are the two most common. There's a few other methods. There's market rate value. There's a few other methods. But today we're going to talk about 3 of the most common ones, and we'll also discuss the factors and how to compute each one. Don't worry, I'll give you some examples. Okay, so before we calculate depreciation, there are 3 things you need to quickly find out. Number 1, what is the asset's original cost? Okay, what is the asset's original cost? And remember, the original cost includes the purchase price plus all the other related stuff, plus installation, plus delivery fee, plus whatever else, right? The cost to get it up and running, basically. Yeah. That's initial cost. You then need to find out, what is the expected useful life? How long is it supposed to last? Now, to find this, there's a couple of different ways. You can either use industry standards, or you could do what most people do and use the IRS depreciation schedule to find its useful life. And then number 3, you need to find the asset's estimated residual value. Okay, what is this? New term, right? Residual value is how much the asset will be worth at the end of its useful life. Or, in other words, what's the scrap value on the asset? We'll talk more about it. So initial cost, purchase price plus the cost to obtain and get it ready for use. Estimated useful life, how long we expect it to last in service. Again, either use industry trade or the IRS schedule. I prefer the IRS schedule, just that's personal preference, but it's usually the best because the reason why, the real reason why depreciation is so important for you to understand, it's not just because accountants need to know this stuff. It's also for the taxes. Oh yeah, you better believe you can deduct that type of stuff from the taxes, my friend. Absolutely. Okay. Residual value. How much it's worth at the end of the useful life. Also known as scrap value. Salvage value, trade-in value, whatever you want to call it. So how much is it really worth at the end of its useful life? Okay. Now, the difference between the initial cost and the residual value is called the depreciable cost. So you figure out what your initial cost is. Remember, that's the purchase price plus delivery plus installation plus whatever else to get it ready to use. Okay, you got your initial cost together minus residual value. Okay, initial cost minus residual value, scrap value, right, equals depreciable cost. And this depreciable cost is how much you will depreciate the asset over time. Okay, here's another example, wonderful example. This company, oh, look, a forklift. How about that? We purchased the forklift on January 1st for $24,000. Expected useful life is 5 years. The estimated residual value, meaning scrap value at the end of its useful life, is $2,000. Now that we know that information, I'm going to show you the 3 most commonly used methods of depreciation. First is straight line method, second is units of activity, and the third is double declining balance. Straight line method, I've talked to you a little bit about. We'll go into more detail. Units of activity. For a forklift, the unit of activity is number of hours driven, used. Most machines have an odometer on them. The odometer is set in hours, meaning how many hours you've used that machine. A classic example would be a riding lawnmower. A riding lawnmower has an odometer on it. The odometer is not miles, it is hours. Hours driven, hours operated. Okay. That is a unit of activity. Is the base of that activity is an hour. The activity itself is mowing the lawn. Right. And the third method most commonly used is double declining balance, which I talked about. But again, we'll just jump a little bit deeper. So straight line is where we have the same amount of depreciation each year over the asset's useful life. The initial cost of my forklift is $24,000. The residual value is $2,000. So 24,000 minus 2,000 is 22,000. So 22,000 divided by 5 years of useful life. So 22,000 divided by 5 equals 4,400. This tells me I will deduct the value of my forklift, 4,400, for a period of 5 years until it reaches a value of 0. We can simplify this straight line by figuring out what we call the straight line percentage. Straight line percentage is a very simple calculation. You take 100% divided by the useful life. So if I go 100 divided by 5, I'm going to get 20. 100 divided by 5 is 20. 100% divided by 5 is 20%. Makes perfect sense. So if my straight line percentage is 20% for that 5 years, I can simply take the cost minus residual value times 20%, and I'll still get 4,400. What about the journal entry? The journal entry at the end of each year. This is what you'll call an adjusting journal entry, or a special journal entry, whichever you want to call it. But it's an adjusting entry, right? That we do at the end of each accounting period. So at the end of each year, I'll make an adjusting entry for the depreciation of my forklift. I debit depreciation expense, 4,400, and I credit accumulated depreciation, 4,400. Now, I want you to understand something. Depreciation expense, that's an expense. That's on the income statement as an expense. Okay. Accumulated depreciation is called a contra account. And I believe we covered this, maybe it was last week or week before. A contra account, think of like contra flow, okay? You got flowing in one direction. Contra is the opposite. It's an opposing force. That's what the word contra means, okay? So you have this opposing force called accumulated depreciation. As you know, assets normally carry a debit balance. Assets normally carry a debit balance. You know that. A contra account that is an asset would carry a credit balance. Accumulated depreciation is an asset account that is a contra account, meaning accumulated depreciation carries a credit balance. Oh, look at that. I just sorry, I got a little ahead of myself. Apparently that was one of the slides. Okay. Now the reason why we use accumulated depreciation is an asset account that is contra is we don't ever just reduce, we don't just take away from the equipment. We don't say, oh, just subtract it off of the balance sheet. No, you can't do that. The original balance must always be on the balance sheet. So even in year 4, it's on my balance sheet, it's still going to say equipment forklift 24,000. Even at the end of year 4. Accumulated depreciation, which is a contra account, that'll always have what a negative balance, if you will, is how we offset it. Okay. And of course, to calculate your book value, you take your initial cost of the equipment minus accumulated depreciation to get book value. And book value is what the forklift will be worth at the end of the first year in this example, 19,600. Okay, so that is straight line depreciation. This is the simplest method, by the way, and one of the most commonly used methods. The second most commonly used method, well, I personally think it's the third one, but the second most commonly used method is what we call units of activity. It's derived based off of the usage of the asset, such as hours used, miles driven, the quantity of inventory produced using that equipment. These are all units of activity. Sometimes it's called units of production. So you might see it in your learning resources as units of production or units of output. It's all the same. They all mean the same thing. Just different terms. That's the thing with accounting. You'll notice, accounting. You may or may not know this. Accounting is almost 3,000 years old. We've been using accounting since humans were able to pick up materials and trade them for value, right? So yeah, it's super old. So we have some terms that have changed over the many years and have not really, what are you going to do, rewrite history? Okay. Anyway, units of activity. How do we figure out the units of activity? The first step is to determine the depreciation per unit. Okay. So in other words, for each level of output, what would be the depreciation for that equipment? So it's the calculation for depreciation per unit is we take, and of course, think of like the imaginary parentheses on the top there. First you do cost minus residual value. Okay, so 24,000 minus 2,000, 22,000. We're still using the forklift. Divided by the total estimated units of activity, the total number of hours I plan to use the forklift. Okay. Uh, and if, that can also be derived from the industry standards or from the IRS. Step 2, compute the depreciation expense. So you take your depreciation per unit that we found in step 1, and we multiply that by the units of activity per period. Okay, so in other words, I'm going to use my forklift for X number of hours in year 1, and then I plan to use it for X number of hours in year 2, X number of hours in year 3, so on and so on. So let's look at our example. The cost of my forklift was $24,000. Residual value is $2,000. That's $22,000. I expect to be able to use my forklift over those 5 years for 10,000 total hours. Okay, so think of the 10,000 hours as my useful life. My useful life is 10,000 hours. That's for my forklift. Okay, so 22,000 divided by 10,000 gives me $2.20 per hour of depreciation per hour. Step 2 is I take my $2.20 per hour, I multiply that by the number of hours I plan to, or I have used my forklift in that first year. I used my forklift for 2,100 hours in my first year. So $2.20 times 2,100 hours in that first year gets me a depreciation expense for year 1 of $4,620. And the journal entry is just like the type of journal entry you made for straight line depreciation. We debit depreciation expense and credit accumulated depreciation for the forklift. Now we assume the following information. In year 1, we used it for 2,100 hours. Year 2, I plan to use it for 1,500. Year 3, 2,600. Year 4, 1,800. And year 5, 2,000 hours. Give me a total of the useful life, 10,000 hours. Now, on to the third method. Double declining balance. The name is exactly what it sounds like. Double declining balance. So think of straight line. Straight line, I showed you how to get the straight line percentage. Straight line percentage. You take 100 divided by the number, the useful life, the number of years. Okay, 100 divided by the number of years useful life. In our example, 100 divided by 5 years gets us 20%. So step 1, 20%. Step 2, determine double declining balance by multiplying straight line rate by 2. So 20% times 2 is 40%. 20 times 2 is 40. So 40%, step 2. Step 3, compute the depreciation expense by multiplying the double declining balance rate times the book value of the asset. For the first year, the book value of the asset is its initial cost. So, year 1, initial cost was $24,000, expected to last for 5 years. Residual value $2,000. Okay, got it. So first figure out straight line percentage. It's 20%. 100 divided by 5 years is 20%. Step 2, double declining balance. 20% times 2, 40%. Step 3, depreciation expense. 24,000 initial cost times double declining rate, 40%, gets me $9,600 of depreciation for my first year. And the journal entry is the same. as it has been for the other two methods. Debit, depreciation expense; credit, accumulated depreciation. Again, you do that at the end of each year. So how do we figure out the rest of it, right? We got year one, but what about the rest? Okay, so the first year, our depreciation was 9,600. The the initial cost was 24,000. So we got a book value at the end of the first year of 14,400. How do we get that? You take the book value beginning of the year minus depreciation for that year equals book value at the end of the year. Now look at year two. Okay. Year two, my book value at the beginning is 14,400. I got that from the end of year one. Times the 40% gives me 5,760. 14,400 minus 557.60 equals 8,640. And then you keep repeating that process. 8,640 times 40% gets me depreciation 3,456. 8,640 minus 3,456 gives me 5,184. 5,184 times 40% equals 2,073 and 60 cents. You see where we're going with this. You do that all the way to the end of year five. Now you see at the end of year five, I have the following information. The beginning year value, okay, 40%, 1,110.40. Remaining book value, end of year five, 2,000. Now remember, the 2,000 comes from the residual value, right? See how that works? It's fun. I forgot I put this stuff in the slide. But yeah, that's the idea. Oh, what about the partial years? So partial years, right? Let's say, because you're not always buying your equipment on January 1. There's a good chance you probably bought it in the middle of the year. Or you bought it, March 1st or May or June or August, whatever, right? So you put it into service. You're not going to wait till the next year to put it into service. You're going to start using it after you buy the asset. So let's assume that we purchased our asset and we put it into service on March 1st. That's clearly not June. That's clearly not January 1st. So 2 months have already passed. So we prorate it. It's kind of like when you move into an apartment in the middle of the month, they're going to prorate your first month rent. That's very typical. The idea behind proration or prorating is that we compute partial components. Okay. And so it's very similar in nature. So for that first part of the year, we would treat it as being purchased on the first day of that month. And then it's very simple. All you do is, once you've figured out what the yearly depreciation amount is, it's just a matter of dividing that by 12, right? And then multiplying it by the number of months it was actually used. So under straight line, as I had said, this works the same way. I mean, you can really calculate it either way. But once you figured out what each year is, 4,400, you could simply divide that 4,400 by 12, multiply by 10. Or you could do it this way, 4,400 times 3 divided by 12. Because October, November, December, right? well, in this example, we bought it on October 1, but you get my point. It works the same way. 4,400 divided by 12 times the number of months it was actually used during that year. That's the whole idea behind it. That's how you get to partial partial year depreciation, and that's very common. That happens very regularly. You do the same exact thing, same type of method for units of activity. Units of activity is even easier because it's still going to be based off of the number of hours used. So, looking at our example, we purchased the forklift on October 1 instead of January 1. So we used it October, November, December. We used it for a total of 400 hours for those 3 months. Man, we were busy, huh? Initial cost minus the salvage value divided by 10,000 hours, $2.20 per hour, which we knew that, times number of hours used. So first year, 880. Makes sense. Very easy. Double declining balance, a little trickier, but not by much. All you're doing here is very similar to what you did in straight line. You're going to take your 3 divided by 12, your 3 out of the 12 months, times the first year depreciation. It's pretty straightforward. Or again, you can just simply take first year depreciation and divide by 12, multiply by number of months that it was used. You do it that way too. They both come out the same way. And then, of course, the second year would start with January 1st, of course, because that second year, you're going to get the full 12 months out of it. Okay. Sometimes you got to revise the depreciation because sometimes things get weird, right? You buy the forklift becomes, something happens to it, right? It explodes for whatever reason, or it gets tipped over and can no longer operate. Things happen to the forklift. I don't know. Somebody goes and does donuts with it in the parking lot, and decides to have a little fun, and then somehow wrecks it. So you got to salvage it, right? So you got to adjust it. You have to get it off of your books. Well, how do you do that? You go through the revision process. Or it becomes obsolete sooner than you thought, or there's abnormal wear and tear, or whatever, right? Or that your business needs change and you sell it. There's a number of different things that can happen to it. Or you're reaching the end of the useful life and you're like, oh, I really want this thing to last a lot longer. So you overhaul the engine and make it a lot better. So what happens? We make revisions. So here's some more data. We purchased a piece of machinery for $140,000. Useful life is 5 years. Estimated residual value, scrap value, $10,000. My annual depreciation using straight line, 140 minus the residual, or initial cost minus the residual value divided by the 5 years is 26,000 per year of depreciation. Okay, simple. I end up, what happens here? Machine book value, undepreciated cost is 80,000 at the end of the second year. Okay, makes sense. Initial cost minus accumulated depreciation equals book value. Beginning of the third year, we decided that the residual, what happened here? Remaining useful life is 8 years. Okay. Well, yeah, of course it is because we said it was supposed to be 10, right? Yeah. No, it was 5. So what happened? Oh, well, we decided to do an engine overhaul on it and extended its useful life by another 3 years. Okay. So great. That makes the residual value 8,000 instead of 10 because now it's going to last 8 years instead of 5. So $8,000 residual value revised, remaining useful life 8 years. So book value minus revised residual value divided by revised remaining useful life gets us to revised depreciation expense of 10,000. The overall point is there are certain things that will happen to assets throughout those years that will either extend useful life or decrease it. And so with those types of revisions, we need to revise our depreciation, of course. Once the asset has been required placed in service, there are some extraordinary repairs and maintenance. The only type of cost that would change the asset are ones that extend its useful life, like an engine overhaul, for example, on a forklift. That would extend its useful life. That would be called a capital expenditure. Okay. Otherwise, it's just a simple expense. Ordinary repairs and maintenance, those are simple expense lines on your income statement. Repairs and maintenance expense, very commonly used expense line on your income statement, and those are just costs associated with keeping the asset in good working condition. Example: change the oil. And here's an example: a tune-up. Tune-ups do not improve useful life. All it means is that I am fine-tuning the engine to make sure it lasts as long as it's supposed to. Okay, you do this with your car every couple of years, typically. Debit, repairs and maintenance expense, credit, cash. Just a very simple expense. But there are some expenses that will affect your depreciation. For example, my forklift engine overhaul, $4,500, but it'll extend its useful life by 8 years. You better believe I'm going to do that, right? So debit accumulated depreciation. Well, now you're like, debit. Okay, I hear you. The reason why we're debiting accumulated depreciation for this engine overhaul is because we are improving its useful life. So we're going to reduce the accumulated depreciation by debiting it. 4,500, we credit cash. And of course, that'll change its book value as well. Because if you're reducing depreciation, accumulated depreciation, obviously that'll increase its book value by that same amount. Because remember, to find book value, initial cost minus accumulated depreciation. So those are called capital expenditures, like an engine overhaul. Let's see. Okay, we put a new hydraulic lift on a delivery truck. That is an asset improvement. It adds value to the asset. And so it's 5,500. We debit delivery truck, which is our existing asset, 5,500. That increases the value of the delivery truck. And we credit cash, pay for it. And of course, obviously, with that improvement, the depreciation amount will change over its remaining useful life. But remember, by my adding a hydraulic lift, I'm not adjusting the useful life itself, because that hydraulic lift is not going to make it last longer, right? The engine's still got to run. Hydraulic lift ain't going to do that. But hydraulic lift going to add value to it. Okay, so I'm not adjusting the useful life. I'm adjusting the amount of depreciation each year, probably upward, right? Over time, our assets are discarded. It no longer works. It's reached a value of 0. You got to remove it from your balance sheet at that point. How do you do it? So let's say my dump truck or my forklift, 25,000. Okay. I reached the end of my useful life. On February 14th, I reached the end of its useful life. Okay. Oh, I had it for 5 years. It was great. It was wonderful. How do I get it off my books? Because now it's not worth nothing and I'm getting rid of it. Okay. To get rid of it, company getting rid of it, you debit accumulated depreciation, 25,000. Because remember, that's how much we accrued over its useful life. And you credit the equipment, 25,000. And what that does is it removes it, that transaction removes it from your balance sheet. If it has not been fully depreciated, obviously we would need to record the remaining depreciation prior to removing it from the books. And in this example, we are making that adjusting entry to fully depreciate the asset before removing it from the books. $150 was remaining depreciation expense. So debit depreciation expense, credit accumulated depreciation for that equipment, and you want to do that before you remove it from your books. What happens if there's a loss? Well, I had to remove the equipment from my book because it stopped working and it still had a year left on it and useful life. Oh, well, you're going to have to record a loss in that case. So you debit accumulated depreciation, debit loss on the disposable of equipment, and credit the equipment for that rest of that value. That happens from time to time. What if you sell it? If you're like, hey, you know what? This thing's been great, but let's get rid of it. Let's replace it with something else. So in that case, it's very similar, right? You need to record the remaining depreciation expense, debit depreciation expense, credit accumulated depreciation. And the credit for the sale is you debit cash, the cash you got from selling the equipment, debit accumulated depreciation, and credit the equipment. Now we'll get it off your books. What if you sold it below its book value? You're just like, man, I just want to get rid of this damn thing. It's not working too well. So you debit cash, the amount of cash you got from the sale. You debit accumulated depreciation. You debit loss on the sale of equipment. And you credit the equipment. But if you sold it for a profit, hey, that's what I like. And, there's nothing wrong with selling it above book value. This happens a lot. Debit cash for the amount of cash you received. Debit the accumulated depreciation. Credit the equipment. And credit gain on the sale of equipment. Isn't that nice? Okay, we're almost done. Real quick, natural resources. Some businesses own natural resources like lumber, minerals, oil, uh, water. I don't know. Naturally occurring things. We need to account for these things because the natural resources, once they're removed from nature, they're technically going to be sold or further processed. And when that happens, we need to account for it. So natural resources are classified as a fixed asset if it's owned by a company and it'll be used at some point for the process and available for sale. Costs of natural resources include costs of obtaining and prepping the natural resources for use. There are a couple of methods for this. It's a thing called a depletion expense, depletion rate. It's very, very similar to depreciation. The idea behind this is that we are accounting for the depletion of natural resources that the company has available for further processing and eventually for sale. So depletion rates cost of acquiring the natural resource divided by the estimated units the natural resource will provide. Step two, we take the depletion rate that we got from step one and multiply it by the quantity of the resource we removed from the earth. An example of this is a mining company. We have the cost of acquiring the mineral deposit, 400,000. We estimate we will be able to extract 1 million tons from the earth, and we will be mining 90,000 tons per year. So our depletion rate, the cost of the natural resource, 400,000, divided by 1 million tons, which is the estimated amount of the resource we'll be able to get out of the earth. That's 40 cents per ton. 40 cents per ton times 90,000 tons we expect to mine during the year is $36,000 of depletion expense. And the adjusting entry is at the end of each year is debit depletion expense, credit accumulated depreciation. So it's very, very, so even companies that extract natural resources from the earth like oil, natural gas, water, lumber from trees, obviously, so forth and so on. They use a very, very similar method that we would use in depreciation. That's the whole point behind me showing you that you will not be tested on that information. But if you ever work for a company that does like mining or drilling or any type of natural earth extraction, that's the type of entries you would be making. What about intangibles? Some long-term assets are considered to be intangible. Intangible means you cannot physically touch it. That would include things like patents, copyrights, trademarks, or goodwill. Instead of depreciating these types of things, we typically amortize them. We determine the initial cost, determine the amortization schedule, and transfer to expenses. Amortization is expensed out over time. The reason being is because the things like a patent from the U.S. Patent Office has a defined life of that patent. So a patent, and as you probably know, a patent is the rights to exclusively use something. It could be like designs for a prototype or whatever. There's a lot of different patents are usually for inventors. Thomas Edison, I think he had like thousands and thousands of patents for all of his inventions, right? And so it gives Thomas Edison the right to use his patents for 20 years without someone else coming along and trying to copy his ideas, basically. That's the whole idea behind it. And so patents are typically expensed out over time. But before we expense them out, the way that it works is because a patent is an asset, just like a piece of equipment, there's a cost of acquiring the patent. So it's initial cost of a purchase patent, or if you're making your own patent, it's the filing fees, plus legal fees, plus insurance, plus whatever, is the total cost, initial cost of the patent. Those costs are written off or amortized over the years of the patent's useful life, 20 years, right? Patent amortization is computed using the straight line method. So, initial cost of the patent divided by useful life, 20 years, giving you the amortization expense per year. So amortization, when you hear amortization, think intangible, depreciation, tangible. Right? That's the whole idea behind me showing you this. Again, you won't be, well, it'll come up, but it'll be like a multiple choice question. Another example is copyrights. Copyrights give you the use to things like music, art, literary stuff, right? Copyright to the government usually about 70 years beyond the author's death. Copyrights can also be bought and sold through the Copyright Office. Just like patents, they are amortized over their useful life. Same with trademarks. Trademarks are, I like to think of trademarks as like patents on the design. An example would be a company logo. There's usually a trademark associated with that logo. Those usually last for about 10 years. The company usually renews it every 10 years. Just like the patents, they're amortized over time. Goodwill. Goodwill is an intangible asset that's created from a favorable acquisition. An example of goodwill I can give you that from my personal experience is I did some work for a company, some consulting work for a company. The company acquired another company, but instead of a straight cash transaction or a straight stock transaction or whatever, we used goodwill. Goodwill, in exchange for cash plus stock plus whatever, goodwill is basically the benefit to that company for the use of the patents that came with the company. And that's what happened in my experience. The only difference is goodwill is not amortized like they are with copyrights and patents. Goodwill is expensed out over time. It's something that's lost over time, if you will. So on the income statement, you'll find the expenses, right? Depreciation expense, amortization expense. The name expense is in the account name. So when you hear expense in the account name, it's on the income statement as an expense. If you hear accumulated amortization or accumulated depreciation, those will be on the balance sheet. And that's what this is telling us. Both long-lived assets that are both tangible and intangible will be classified on the balance sheet under fixed assets. Property, plant, and equipment, just as you see here, and then intangible assets like patents. This is how it'll look on the balance sheet. So you'll have the initial cost. So land, 1.85 million. You'll never see that be depreciated. Land never depreciates. Only building and equipment do. Building, initial cost, 2,650,000. Depreciated 420,000 to its current during this current period. Current book value of the land is 2,200,000. $30,000. How did you get book value? Initial cost, initial cost minus accumulated depreciation equals book value. Remember, book value is not the same as market value. Those are different things. So forth and so on, right? So, but that's what it looks like on your balance sheet. Real quick, of course, real quick. Assets, ratios. Understanding how well a company utilizes their fixed assets is very important. How I'm using my fixed assets to generate sales, generate revenue. You got to know how well the company is using their assets to generate revenue, fixed assets in particular. So in order to figure out how well a company is using their fixed assets to generate revenue, the ratio you want to calculate is you take your sales, which is the same as revenue, right? Divided by average book value of fixed assets. Now, the average book value of fixed assets comes from your fixed assets at the beginning of the year plus the value of your fixed assets at the end of the year divided by 2 to get the average, right? So revenue, sales divided by average fixed assets equals the fixed asset turnover ratio. Anything above 1 is considered good. And that, my friends, is the end of our presentation. Joe, any comments, questions, concerns?
No, it was pretty clear this week. Thank you.
Awesome. Cool. Yeah, I like when things are straightforward. Yeah. Very cool. Awesome. Well, thank you so much, Joe. I appreciate you taking the time to join me. For the rest of you, I hope that this video is going to be helpful for you. Just to kind of recap, we are currently in week 5, fixed assets, property, plant, equipment. This week, I'm recommending that you please read through your learning resources. Come down to the homework section. You'll have a discussion on rights of use for assets. That's a fun discussion. You'll have your homework assignment. It will be on property, plant, equipment. I think it's like 15 questions, something like that. The same number of questions that has been previously. You'll have your second exam. The second exam will cover content from weeks 3 and 4. There may be maybe 1 or 2 questions from week 5. So because of that, my recommendation is first read through, study up, right? First do your self-assessment, then do your homework assignment, then review what you learned in weeks 3 and 4, and then take the exam. I recommend you say the exam toward the end of the week, because that will certainly give you enough time to study and, of course, to review everything you learned. Okay. And then, of course, you'll have your standard weekly report. I'm in the process of grading. I will hopefully have week 4 graded here in the next 2 days. Again, thank you so much for your time. If you run into any comments, questions, or concerns, please feel free to call me, set up office hours with me, email me. I'm here for you 100% of the time. So any way you want to get at me, I'm here. Thank you so much. Appreciate all of you. And I hope everything goes well. Thank you so much.